I think that most of the people watching my videos would agree that it is next to impossible to beat the market consistently through stock picking or market timing. Knowing that, it is sensible for investors to look for other ways to get more out of their investments. Tax planning is one way that investors can keep more of their returns. Asset location is a form of tax planning. Note that I am not talking about asset allocation, which is deciding how much of each asset class you should hold. Asset location is the practice of holding certain asset classes in certain account types. For example, holding bonds in the RRSP and Canadian stocks in the taxable account to minimize the overall tax drag on returns. Finding the optimal location for each asset class is accomplished by holding the assets with the highest tax costs in non-taxable accounts. Easy, right? Well, it is easy if you know the magnitude and characteristics of future returns and future tax rates. Otherwise, it's really, really hard. I'm Ben Felix, Associate Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why you shouldn't get lost trying to locate your assets. Asset location typically follows a set of rules. The rules make sense assuming that we know future returns. Number 1, hold fixed income in your RRSP because interest income is taxable at your full marginal rate, and the lower expected returns should lead to lower RRIF minimums. Number 2, hold Canadian equities in your personal taxable account because Canadian dividends are taxed at a more favorable rate than interest or foreign dividends. Number 3, hold international equities in your TFSA because international stocks tend to have higher yields and foreign dividends are fully taxable. Number 4, hold U.S. equities in your RRSP, but not before fixed income, because a U.S. listed ETF of U.S. stocks will avoid foreign withholding tax altogether. Much has been written about asset location and the value that it might be expected to add to after-tax returns. The value of asset location is measured against holding the same mix of assets in all accounts. In a 2013 paper from Morningstar, David Blanchett and Paul Kaplan determined that asset location might add 23 basis points of value per year to after-tax returns. In a 2014 paper, my PWL colleagues Dan Bortolotti and Justin Bender determined that optimal asset location would have added 30 basis points per year to the after-tax returns of an ETF portfolio between 2003 and 2012. In a 2017 paper, I used statistical analysis to test an asset location model and found that optimal asset location would add 23 basis points of value per year on average to after-tax returns in an ideal situation. My ideal situation included an investor taxed at the highest marginal rate in Ontario, with enough RRSP room to hold most of their bonds while staying in line with their target asset allocation. Using Monte Carlo analysis, I tested this optimal asset location strategy against uncertain returns by running 1,000 simulations and found that in about 80% of outcomes, asset location did in fact add value. While this was an interesting finding, I was still assuming that we are able to predict future returns. Any asset location optimization decision is based on the expectation of future returns. Of course, we cannot know future returns. To test the robustness of my optimal asset location decision against my inability to know the future, I ran the Monte Carlo model against actual returns instead of the expected returns that had been used to make the optimal asset location decision. Under these circumstances, the average value added dropped from 0.23% to 0.07%. More importantly, the optimal asset location strategy only outperformed holding the same mix of assets in all accounts 58% of the time. When we realize that asset location does not guarantee higher after-tax returns, we should start to wonder about the other issues that may arise. There is some regulatory risk. An optimal asset location strategy under the current tax rules could become suboptimal under new rules. For example, if the tax rate on Canadian dividends increased or capital gains inclusion increased, a previously optimal location of assets could become suboptimal. There is also the added complexity. If you are managing your own portfolio, complexity makes things like rebalancing or investing new money a challenge. If your assets are managed by a wealth management firm, optimizing asset location reduces their ability to scale, inevitably leading to higher fees over the long term. I am not alone in my skepticism about optimal asset location. In a 2009 paper, Gerard O'Reilly of Dimensional Fund Advisors outlined his attempt to model optimal asset location and concluded that the model was too sensitive to its inputs to define an optimal asset location strategy. In a recent blog post, John Robertson, Canadian author of The Value of Simple, explained, "When the experts can't even agree on what optimal is, then you know it's not worth your time to worry about. If you defer investing your contributions for a year or two because you have to find a bigger block of time to plan out where everything goes, or if you ignore rebalancing because it's too hard with everything in separate accounts, then it's not worth the potential savings." He concludes the post, "This is all very confusing, and my default suggestion is that it's best to just replicate the same allocation in all your accounts." In response to a comment on one of his blog posts, my PWL colleague Justin Bender wrapped my thoughts up perfectly. There are many thoughts on the asset location decision, and in the end, it probably doesn't matter much. Put simply, if we cannot predict the future, the value of trying to optimize for asset location can be called into question, and it may even make you worse off in the end. I think that this should be considered by anyone struggling with the complexity, or even worse, delaying the implementation of their portfolio due to asset location concerns. I do not attempt to optimize the location of assets in the portfolios that I oversee, opting instead to hold the same mix of assets in all accounts. Do you have an opinion on the asset location decision? Tell me about it in the comments. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. I'll be talking about a lot more common sense investing topics in this series, so subscribe, click the bell for updates.